So if you've spent any time at all tracking the tech news cycle over the last, 18 months, the AI sector is just experiencing a financial explosion.
Oh, absolutely.
We're talking about massive investments, these dizzying valuations, and companies just racing to outspend each other for compute power.
It feels like every week there's a new eye-watering fundraising round.
Exactly.
It creates this really captivating story, right? A
Mhm.
narrative of just unbounded potential. But what makes this whole market moment so fascinating is this growing tension inside of it.
Right. The public story is all hype.
Pure, unadulterated hype.
Mhm.
But a very serious counter-narrative, a stark warning, is starting to come out. And it's not from outside skeptics, it's from inside the industry.
From the very executives building the models.
Precisely.
That's the key. We aren't just relying on, the usual market analysts who are naturally a bit skeptical of high growth. We're talking about the builders themselves, people like Anthropic CEO Dario Amodei, who are starting to sound the alarm. So for this deep dive, that's our mission. We need to unpack these specific concerns. We want to analyze whether the AI sector is truly in a legitimate, maybe even necessary, trillion-dollar technological shift.
Or if the current financial climate is just propelling it towards a huge, unsustainable, and maybe even self-created investment bubble.
Exactly.
And to get to the bottom of this, we've synthesized a whole range of insights. We're looking at major media reports.
Like The Verge, Fortune, CNBC.
Right, the Times of India, CBS News, but maybe even more importantly, we've been tracking the real-time commentary.
From the actual investors, the technologists on platforms like X.
Exactly, from the people right there in the thick of it. And the central conflict we're framing today is really this tension between the need to scale super quickly and the urgent, perhaps even existential need for long-term viability.
And safety and prudence.
Yes, and right now, Amodei's argument is that speed and spending have just completely eclipsed prudence.
Okay, so let's unpack that core warning. Let's dive into the mechanics of this spending spree. Amodei has been really clear about the philosophy driving this potential bubble. And he summed it up with a term that, it just implies reckless abandon.
YOLOing.
YOLOing.
Yeah, he actually used the term YOLOing, you only live once, to describe this impulsive, high-risk spending behavior that's just so prevalent right now.
And it's not just about spending a lot of money, is it? It's a critique of the whole mindset.
It's the whole mindset, the idea that you have to achieve this massive scale immediately, no matter the cost, no matter the long-term return on investment. The fear is that the race itself has become way more important than the finish line.
But he didn't just stop at criticizing the feeling of it all. He got into the specifics, the clever and potentially deceptive financial mechanisms that are propping this all up. He pointed directly to what he called big circular deals.
The circular deals, yeah, as the engine inflating valuations.
Okay, so what exactly are these circular deals? Why are they so problematic?
Well, that's the critical financial mechanism you have to understand. A circular deal, it essentially creates this appearance of explosive growth and huge investment.
But without any new money actually coming in.
Exactly. Without injecting new organic capital or proving there's any real market demand. So imagine a big tech conglomerate invests, say, $10 billion into a foundational AI company.
It's great on paper. Huge valuation boost.
It looks fantastic for the valuation. But then, and here's the key, as a condition of that deal, the AI company immediately turns around and signs a massive contract, maybe for $2 billion, to buy compute services exclusively from the investor's cloud division.
Ah, so the cash just cycles right back into the original investor's ecosystem.
Precisely. So the AI company gets this huge headline valuation boost, and the investor's cloud division, well, they get a massive guaranteed revenue contract.
Which also boosts their valuation.
It's a closed financial loop. It makes the AI company look way more valuable and revenue positive than it would be if it had to go out and compete for that same $2 billion on the open market.
And Amodei sees this as just an unsustainable way to inflate the market.
It is, and it really feels like a veiled jab at rivals, maybe like OpenAI, who have been at the forefront of these really complex, enormous fundraising rounds.
And crucially, this isn't just some internal company rivalry. Amodei's perspective is getting backed up by some serious external validation.
Most notably from Mark Cuban.
Right.
Cuban has been extremely vocal about this. He's publicly cautioned all the big players, OpenAI, Anthropic, Google, Microsoft, against this excessive spending on large models.
He compared it to a gold rush, right?
an old-fashioned gold rush, but with a really important warning. In a gold rush, the people who often make the most money aren't the miners.
It's the people selling the picks and shovels.
Exactly. And in this analogy, the shovels are the NVIDIA GPUs, the compute infrastructure.
It's a powerful analogy.
It is. Cuban's warning is that while these AI companies are just burning cash like crazy, only a few are actually going to strike gold. The real guaranteed winners are the semiconductor companies and the cloud providers. They're selling the tools no matter what.
Regardless of whether the AI models they power ever actually become profitable.
Right. And that constant enormous demand for compute, often financed through those circular deals we talked about, is pouring these unprecedented sums into infrastructure, even before we have any proven sustainable revenue models.
That fear of non-sustainable returns brings us right to the financial stakes and, well, the irony in Anthropic's own actions. Because if we look at the broader macro environment, financial experts and, central bankers, they're all echoing similar warnings about overvaluation.
That's right. Our sources are indicating that senior financial officials globally are worried. They see the AI sector as the flagship example of how all this excess global liquidity, just this enormous amount of money sloshing around the system, is fueling asset bubbles.
And not just in AI.
Not just in AI, but across multiple tech sectors. Valuations are just soaring into the hundreds of billions, and it's often based on potential revenue projections that are, decades out.
Not based on any near-term profitability.
Not at all. And this is where the paradox becomes so fascinating.
Right. Because Anthropic has done a great job positioning itself as the cautious player, the safety-focused, responsible one in the generative AI space.
They preach restraint.
But then they recently announced a staggering $50 billion commitment to AI infrastructure.
And that is the central contradiction that Amodei has to navigate. You just can't advocate for financial prudence and systemic safety while you're simultaneously engaging in this high-stakes, multi-billion-dollar arms race for compute power.
Critics are pointing that out, right?
Oh, absolutely. Critics argue that by announcing a commitment of that size, Anthropic is basically contributing to the very market inflation Amodei is warning about. They're forced to play the YOLO game just to stay competitive.
So it's the cost of entry. You have to spend to even play, even if you think the spending is reckless.
That's the necessity they face. And we know they aren't slowing down.
No.
Anthropic is reportedly considering an IPO, an initial public offering, as early as 2026.
And that move is hugely significant.
It is. The analysis suggests that even with their focus on safety and solid research, their suggested $300 billion valuation. It might be testing the absolute limit of investor enthusiasm.
So that IPO isn't just important for Anthropic, it's really a crucial litmus test for the entire market.
Absolutely. If Anthropic goes public and validates a $300 billion valuation, it will justify the current spending across the whole sector, from OpenAI all the way down to the smaller startups.
If it struggles.
If that IPO struggles, it could trigger a fundamental, rapid reassessment of pricing for every single major AI player. It's the first real moment where the public market gets to rubber stamp or reject this whole circular deal valuation model.
And while all this financial maneuvering is happening, you've got the environmental and infrastructure concerns just mounting. Looking at social media commentary, the sentiment is just thick with worry about overcapacity.
Yeah, discussions on X are projecting these huge figures. Some suggest up to $2 trillion in excessive overbuilt infrastructure spending could happen in just the next few years.
Which isn't just financial waste.
No, it translates directly into higher energy consumption and significant resource waste for compute clusters that might just sit idle or get retired early when the market finally corrects.
We're building based on FOMO, not on necessity.
That's the idea.
So if the financial engine is based on reckless spending, the risks just inevitably move beyond Wall Street and, well, into society at large.
And this is where Amodei and his co-founder, Jared Kaplan, they shift the whole conversation.
From financial peril to ethical and societal risks.
Exactly. And this is a necessary and, frankly, a profound shift. Kaplan gave this stark warning that we are rapidly approaching a critical juncture.
The moment when AI can design its own successors.
Yes. That capability, recursive self-improvement, means the speed of technological advancement could just move beyond human control, posing potential existential risks if it's not governed properly.
What's the time frame they're talking about? It sounds like they believe the window is closing fast.
They're being very specific. Kaplan stressed that the industry and global regulators, they have to make a big decision on governance and control before 2030.
That is less than 6 years away.
Less than 6 years. He sees 2030 as the potential point of no return for effectively governing this technology before it achieves true autonomy and the capability for self-replication.
It's a dramatic warning, but our sources show this isn't just some theoretical sci-fi concept. These vulnerabilities are already emerging in really practical, exploitable ways.
They absolutely are. Anthropic's own research, their own, has demonstrated these highly sophisticated AI agents that can exploit flaws in smart contracts.
And for you listening, if you're not familiar, smart contracts are basically just code on the blockchain that automatically execute financial transactions.
Right. And if an AI agent finds a subtle flaw in that code, it can successfully reproduce hacks that have previously netted real-world attackers millions of dollars.
So the rapid, uncontrolled advancement Amodei warns about, it's translating directly into exploitable financial and security risks today.
And the most immediate, tangible economic threat we're seeing is on the labor market.
Right. Amodei is predicting significant unemployment from automation, specifically targeting the white-collar sector.
The displacement is projected to be immense. Discussions circulating on X, they frequently cite estimates of up to 20% unemployment.
20%.
Just from AI displacing knowledge workers and white-collar professionals. And these aren't factory jobs. We're talking about paralegals, coders, analysts, writers.
And a displacement of that scale requires systemic solutions.
It has to.
Which is why we're seeing ideas like the one from investor Shea Ballor, the agentic AI tax. Can you explain that concept?
Sure. The basic premise is to acknowledge that if these increasingly sophisticated software agents, AIs, are taking on tasks that were previously done by humans, well, they should shoulder the same societal burden that human labor does now.
So you tax the agent.
You place a tax on the use of these autonomous agents, and the money would be used to fund a universal basic income, a UBI. It's a real attempt to mitigate the economic shock of mass automation.
It connects the financial benefits of scaling AI directly to the societal cost of displacement.
That's the idea.
It's a pragmatic attempt, at least. So as we shift to the path forward, it is important to note that the industry response to all this bubble talk is, well, it's nuanced.
It is.
While some parts are clearly showing signs of overindulgence, other areas are facing genuine constraints.
And this is where someone like Andrew Ng, another really influential figure in AI, offers a very valuable, differentiated perspective that he shared on X. He argues that the spending is misallocated, not entirely unnecessary.
Okay, so he draws a sharp distinction between two types of AI infrastructure. What are they?
N says we have an overbuilt training infrastructure. That's the YOLO spending we've been talking about. The massive compute clusters for building the biggest, most expensive foundational models.
He argues that specific area is bubbly.
That part is bubbly. However, he says there is an underinvested application layer.
Meaning?
In other words, companies are spending way too much on the foundational R&D and not nearly enough on developing practical, profitable, accessible use cases.
The actual software products that customers will pay for.
And that will justify these astronomical valuations in the long run.
But standing in direct contrast to N's view and maybe fueling this whole spending spree is the perspective from NVIDIA CEO Jensen Huang.
Yeah, Huang's view is simple. The demand for AI compute is exponential, and it is nowhere near satisfied. From where he's sitting, the idea of overcapacity is just laughable.
I'm sure it is.
He stresses that we have to support these scaling efforts, despite the financial risks, because the underlying demand is just outpacing supply. His company is benefiting directly from selling the picks and shovels, and he believes we're in the early stages of a necessary trillion-dollar build-out, not some arbitrary bubble.
And this just illustrates that fundamental polarization in the market. Meanwhile, you've got the regulators circling. We mentioned central bank chiefs are monitoring these liquidity flows.
They're wary of systemic risk. I mean, if a major player with a valuation in the hundreds of billions suddenly collapses because of unproven profitability,
or if that $300 billion IPO fails dramatically.
The ripple effect could be felt far beyond the tech sector, and this financial oversight is adding urgency to the conversation about what comes next.
Which takes us right back to Mark Cuban's warning. Overspending at this scale can only end one way.
Exactly. This massive spending raise is, at its core, anti-competitive. It sets the cost of entry so high that consolidation is just the inevitable endpoint. Ultimately, only one or a handful of players will survive to dominate the market.
concentrating immense technological and political power.
Immense power.
And finally, we have to acknowledge the polarized public view that you see all over social commentary. Some people still see a massive, definite bubble, and they often point to specific, high-stakes legal events.
A prime example is that $1.5 billion copyright claim filed against Anthropic. For skeptics, an event like that signals real fragility.
Why, though?
Because the core value of these models rests on the data they were trained on. If these legal challenges over training data succeed, especially claims from large groups of artists and creators, it could fundamentally disrupt the valuation and viability of the foundational models.
And lead to that market collapse skeptics are predicting.
Right, but then you have the other side.
Others who look at the pace of innovation humanoid robots, the very real compute shortages, and they see irrefutable proof of a genuine, necessary technological transformation.
So the path forward, it seems, requires some radical restraint. Amodei's critique is this crucial call for a more sustainable approach. He wants to ensure that the incredible promise of AI, which is real, isn't lost in an overly aggressive, financially unsustainable YOLO strategy.
Which invites long-term financial, ethical, and societal peril.
Yes.
So the core takeaway here is that the AI market is navigating this dangerous paradox. We're simultaneously seeing a genuine, transformative technological change and a completely reckless financial overindulgence.
Fueled by competitive pressure and these complex circular deals, it's a very, very difficult tightrope for everyone to walk.
Investors and innovators alike.
And Anthropic, by moving towards its potential IPO in 2026 with this ambitious valuation, it really is the ultimate bellwether. Its success or failure in the public markets will either validate these sky-high valuations across the board,
or it'll fundamentally shatter them. Leading to that crucial reassessment, the market desperately needs to become sustainable.
Right. It's a moment of profound consequence, not just for investors, but for all of us.
We heard Jared Kaplan warn that AI could soon design its own successors. He gave us a hard deadline of 2030 for governance. And when you think about that specific existential warning, and you put it next to the financial recklessness, the environmental waste, the labor displacement fears, it just raises a huge question we all need to consider.
Given the urgency and the stakes, what societal costs, ethical, environmental, and financial, are we implicitly agreeing to pay right now by prioritizing speed and spending over safety and prudence and governance? When we embrace this YOLO approach to a technology that can soon govern itself, we are making a choice that extends so far beyond the bottom line. And that is why understanding the mechanics of this bubble is absolutely crucial, whether you're an investor or just an observer.